Hey everyone, welcome back. Today we're taking a deep dive into Garware High-Tech Films Ltd.
Sounds good.
Specifically, their second quarter performance for fiscal year 2025. You guys wanted to know more about their financials and those key ratios everyone keeps talking about. So we're going to unpack all of that, and also who are the big players making the decisions. We've got all the data and analysis from Screener ready to go. So
Yeah, let's do it.
let's jump right in. First things first, Q2 FY25 results. What were the big takeaways?
Well, right off the bat, their revenue, it's a massive 621 crore rupees.
Whoa.
A whole 38% jump year over year.
38%. That's not just growth. That's like a full-on sprint. I'm guessing that means a pretty healthy bottom line as well.
You're on the right track there. Their operating profit hit 137 crore rupees,
Right.
which translates to a 22% operating profit margin.
Okay.
They're keeping those costs under control and squeezing out some solid profits.
So they're making money, but are they efficient? What do the EBITDA margins tell us?
Okay, so their EBITDA margin for Q2 FY25 sits at a pretty healthy 25%, which basically means for every rupee they generate, a quarter of it is pure profit.
Wow, a quarter. That's pretty impressive. All right, now let's get to the real meat of it, PAT, or profit after tax.
Right.
What's the story there?
They landed at a solid 104 crore rupees. Remember, last quarter it was 88 crore. So this jump is directly related to that strong revenue growth and those consistently strong margins.
They seem to be firing on all cylinders. But what about their trade receivables? They're sitting at 279 crore rupees. Is that a red flag?
Well, trade receivables are definitely something to keep an eye on, but we need to see how that figure changes over time. If it starts to grow disproportionately to their revenue, then maybe it's a sign they're having trouble collecting payments. But for now, I wouldn't jump to conclusions.
Fair enough. Lastly, let's talk about free cash flow. What kind of shape are they in there?
All right, they've got 48 crore rupees in free cash flow.
Okay.
Which is, the cash they have left after covering all their essential expenses and investments. It's the lifeblood of any business.
Right. Yes. Positive figure means they have resources to invest further, maybe reward shareholders or pay down debt strategically.
Positive free cash flow. That's music to any investor's ears. So far, it seems like they're doing pretty well. But we've got a whole other layer to uncover. Those key financial ratios. That's coming up after the break.
So now that we've looked at Garware High-Tech Films' performance in Q2, let's shift gears a bit and dive into those key financial ratios. These ratios can, really help us understand the company's financial health and efficiency.
Yeah, let's crunch some numbers. Which ratios are we looking at today?
Well, we'll be examining their price-to-earnings ratio, debt-to-equity ratio, interest coverage ratio, PAT to CFO, return on capital employed, return on equity, and lastly, asset turnover.
Okay, wow, that's a lot. I'm intrigued. Let's start with the price-to-earnings, or PE ratio. Screener has it at 38.5. What does that tell us? So the PE ratio basically shows us how much investors are willing to pay for every, rupee of the company's earnings. A high PE like this usually means the market is expecting some strong future earnings growth. It's kind of like a vote of confidence in Garware High-Tech Films' future.
So the market's optimistic. But does their performance in Q2 justify that optimism?
Well, their strong Q2 performance and their, dominant market share definitely gives some weight to that optimism. But remember, a high PE ratio can sometimes also mean that the stock is overvalued. So we got to consider other factors too before making any judgments.
Good point. Let's move on to their debt-to-equity ratio.
Right. So this ratio measures the company's financial leverage, basically how much debt they use to fund their assets. A lower ratio generally indicates a healthier financial position. And in Garware High-Tech Films' case, Screener highlights that they're almost debt-free.
Debt-free? That sounds amazing. Where do we see that in the data?
Take a look at their balance sheet on Screener. Their total debt is significantly lower compared to their equity. This low debt burden gives them a lot more financial flexibility, and it also makes them, less vulnerable to interest rate fluctuations.
Makes sense. Less debt usually means less risk. Okay, next up, the interest coverage ratio.
Right. So the interest coverage ratio tells us how easily a company can cover its interest expenses using its operating profits. Garware High-Tech Films has a pretty high interest coverage ratio, meaning they have no problem meeting their interest obligations.
That's good to hear. High interest coverage definitely means financial stability. Now, what about the PP to CFO ratio? What does that one tell us?
Okay, so this ratio compares a company's profit after tax, PAT, to its cash flow from operations, CFO. It basically helps us see if the reported profits are actually turning into real cash.
So it shows us that those profits are actually real, not just on paper.
Exactly. A high PAT to CFO ratio means that profits are converting into actual cash flow. which is a good sign, of course. We'd need the exact figure for Garware high-tech films, but, their strong cash flow performance in Q2 suggests this ratio should be healthy.
Fingers crossed. Now let's talk about ROCE, or return on capital employed.
All right, so RACE is a very important profitability ratio. It measures how efficiently a company uses its capital to generate profits. Garware High-Tech Films has an impressive 14% ROCE.
14% does sound pretty good. What's contributing to such a high ROCE?
Their market leadership and operational efficiency are definitely key factors. Their strong market share in specialty films lets them, command premium pricing and maintain healthy margins, which directly contributes to a higher ROCE.
Ah, I see. It's all connected. High market share, healthy margins, strong ROC.
Yeah.
What about ROE, or return on equity? How does that compare?
So ROE focuses specifically on the return generated on shareholders' investments. Garware High-Tech Films has an ROE of 10.4%, meaning they're generating a decent return for their equity investors.
10.4%. Not as high as their ROCE, but still respectable. What explains the difference between the two?
The difference mainly comes from their debt levels. Even though they're practically debt-free, they still carry some debt. ROCE takes into account both debt and equity financing, while ROE focuses solely on equity. So even a little bit of debt can create a difference between those two.
Interesting. Each ratio gives us a different perspective on the company. Okay, finally, let's talk about asset turnover.
Right. So asset turnover measures how effectively a company uses its assets to generate revenue. A higher asset turnover ratio means they're more efficient at using their assets to drive sales. We'd need the specific number for Garware High-Tech Films to really assess their performance in this area.
Got it. So we've gone through a bunch of ratios: PE, debt to equity, interest coverage, PAT CFO, ROC, ROE, and asset turnover. What's the overall takeaway? What's the story these ratios are telling us about Garware High-Tech Films?
Well, these ratios paint a picture of a financially sound and efficient company. Their low debt, high profitability, and impressive return on capital employed all point towards a strong financial foundation.
That's great news, but I'm sure no company is perfect. What are some potential risks for Garware High-Tech Films? And let's talk about who's running the show, the shareholding pattern. All that's coming up after the break. We're back and ready to wrap up our deep dive into Garware High-Tech Films. We've covered their financials, their performance in Q2, and all those important ratios. Now, let's talk about the people behind the company, the shareholders.
Yeah, shareholding patterns are really interesting. They can tell you a lot about a company's stability,
Yeah.
and where it might be headed.
Okay, I've got the shareholding pattern data from Screener pulled up for September 2024. What jumps out at you?
Well, the first thing I notice is the promoters hold a big chunk of the shares, 60.73% to be exact.
Okay.
That's a strong sign they're committed to the company's success over the long term.
So they're not just in it for a quick buck. They're here to stay.
Exactly. It's a vote of confidence from the people who know the company best. Now let's see what the foreign institutional investors, FIIs, and domestic institutional investors, DIIs, are doing. Those are the big players, mutual funds, pension funds, insurance companies.
Right. They definitely have a lot of influence. What's their take on Garware High-Tech Films?
Well, both FII and DII holdings have been increasing lately over the past few quarters. It seems like those savvy investors are seeing something promising in Garware High-Tech Films.
So the promoters are bullish, and the institutional investors are buying in. What about the public holding? What's happening there?
Public holding has actually decreased a little, which isn't too surprising considering the increase in FII and DII investments.
Okay, so we've got stable promoter holding and increasing interest from institutional investors. What does all this mean for the average investor? Like, what does it mean for me?
Well, a stable promoter holding is generally a good sign. It suggests the company is likely to stay on course, and increasing feedy interest could bring more attention to the stock, maybe even drive up the value. But it's always important to remember, past performance isn't a guarantee of future results. Investing always has some level of risk.
Very true. Always do your own research before making any investment decisions. So, as we wrap up this deep dive into Garware High-Tech Films, what are the key takeaways for our listeners?
We've seen that Garware High-Tech Films is a financially strong company. They hold a strong position in a growing market, and their Q2 FY25 performance was excellent. Strong revenue growth, healthy margins, and positive cash flow. And those key financial ratios we talked about. They all show that the company is financially stable, efficient, and has an impressive return on capital employed. Plus, with that stable promoter base and growing institutional interest, the outlook seems pretty positive.
Wow, we covered a lot today. From their financials to the people making the decisions behind the scenes. Any final thoughts for our listeners?
Absolutely. Remember that no company operates in isolation, right? Think about the potential risks and opportunities that might be out there for Garware high-tech films. How might their strategic decisions, like reducing debt or expanding into new markets, affect their future performance? These are some things to consider as you continue to learn about this company.
Excellent points. We hope this deep dive has given you some valuable insights into Garware high-tech films.
Yeah.
Keep learning, keep exploring, and as always, stay curious.